Hello students, welcome to the class. Myself N.K. Thukral from Edupedia World. Students, in the previous section I have discussed on Indian insurance sector, insurance policies and type of insurances. In the last session I had discussed on life insurances and types of their covers and about the development of life insurance, etc. Today I will be taking the chapter on health, fire and marine insurances. As you know, there are two types of insurances, life insurance and general insurance. Under general insurance, there comes fire insurance, marine insurance, health insurance and other insurances like motorbike, burglary, cattle, crop, sports insurance, etc. As students, you know, with the initiation of financial sector reforms, the Indian insurance sector, which was till now under the government control, has to set open for competition to meet the global challenge. The Indian insurance market is a mega market with a huge potential. Since the opening of the insurance sector in December 1999, the insurance industry is changing rapidly. Today, more than 15 companies operate in the life insurances and more than 50 in non-life segment. LIC of India has dominated the life segment for over 4 decades. So, like life insurance, other insurances are equally important in the industry. Health insurance is a safeguard against rising medical costs. A health insurance policy is a contract between an insurer and an individual or group in which the insurer agrees to provide specified health insurance at an agreed upon price, that is the premium. So depending upon the policy, premium may be payable either in a lump sum or in installments. Health insurance usually provides either direct payment or reimbursement for expenses associated with illness and injuries. The cost and range of protection provided by health insurance depends on the provider and the policy purchased. In India, presently, the health insurance exists primarily in the form of Mediclaim policy offered to an individual or to a group or association or corporate bodies. Now students, let's see what exactly is health insurance, why health insurance is required, and what about their premium and claim settlement. First of all, let me tell you what is health insurance. Health insurance policy is a contract between an insurer and an individual or group in which the insurer agrees to provide specified health insurance at an agreed price, that is called premium. So this is what health insurance policy is. So means it is a contract between the insurance company and individual or group or corporate body in which the terms and conditions are agreed between both the parties, and also what is the premium payable, accordingly it is also agreed between the two parties. So this is called health insurance policy. Now why health insurance is required? What is the reason? Health insurance is taken as a safeguard against rising medical costs. It also provides risk coverage against unforeseen health expenditure that may result in financial hardship to the individual. Now what about the premium? How the premium is decided, how it is worked out? Insurer put terms and conditions to the corporate body or individual, what type of cover individual wants to take. Accordingly, premium is decided. So premium is decided based on the total coverage as well as period also. Depending upon the policy, premium may be payable either in a lump sum or in installment. Now students, let's know what about the claim settlement. How the claim is settled? There are two methods by which health insurance claims are settled. Number one method is cashless. Second method is reimbursement of expenditure. Cashless, as you know, the claim amount needs to be approved by the third party administrator, that is called TPA, and the hospital settles the amount with the TPA only, as the third party administrator is a middleman between the insurer and the customer. Second method is reimbursement. Here in this case, the insured avails the treatment from the hospital and settles the hospital bills directly at the hospital. Individual pays from his own pocket first of all, then the insured can claim reimbursement later on by submitting relevant bills, documents for the claims amount to the TPA. This is how the claim is settled between the insurance company and the insured. As there are so many companies in the private sector which are operating health policies, but the general features offered by the medical policies are reimbursement for hospitalization due to disease or surgery, reimbursement for domestic hospitalization expenses in lieu of hospitalization, pre-hospitalization expenses up to 30 days, post-hospitalization expenses up to 60 days, age limit may be 5 years to 80 years. So these are the general features covered under the policies by various private sector. Now next type of insurance is fire insurance. What is fire insurance? Fire insurance is a contract whereby the insurer, in consideration of the premium paid, undertakes to make good any loss or damage caused by fire during a specified period up to the amount specified in the policy. Normally the fire insurance policy is for a period of 1 year, after which it is to be renewed from time to time. If policy is not renewed, insurance policy lapses, and if fire occurs thereafter, insurer is not responsible. So it must be understood that policy must be renewed whenever it going to lapse. The premium may be paid either in lump sum or installment. In fire insurance policy, a claim for loss by fire must satisfy two basic conditions. Number one is there must be actual loss, and second is fire must be accidental or non-intentional. This is the ingredients of fire insurance policies. Now students, let's see what are the essential elements of fire insurance. Essential elements of fire insurance contracts are: number one is the insured must have insurable interest. Now what is insurable interest? It means insurable interest must be present both at the time of insurance and at the time of loss. In fire insurance, the insured must have insurable interest in the subject matter of the insurance. For example, a person has insurable interest in the property he owns. A businessman has insurable interest in his stock, plant, machinery or building. An agent has an insurable interest in the property of his principal, and a partner has insurable interest in the property of a partnership firm. This is what insurable interest is. The second feature is based on good faith. It means the insured must be honest and truthful and should disclose all material facts about the subject matter and risks attached to it. Similarly, the insurer should also disclose the facts of the policy, means all terms and conditions applicable at the time of claim. So these must be understood by the insured. So on both sides, utmost good faith is required. No material facts should be hidden. Another essential element is principle of strict indemnity. It means in the event of loss, the insured can recover the actual amount of the loss from the insurer subject to the limit of amount covered by the policy. Under no circumstances the insured is allowed to make profit out of contract. Another element is fire to be the proximate cause. It means nearer. The insurer is liable to compensate for the loss only when the proximate cause of loss is fire. Means nearer cause is there. It should be very, very proximate to the fire. So these were the essential elements or ingredients of fire insurance. Now students, let's see what is marine insurance, another type of insurance. Marine insurance is a contract of insurance under which the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed against marine losses. I mean to say shipping losses. The insured pays the premium in consideration of the underwriter's guarantee to make good the losses arising from marine perils or perils of the sea. Marine perils can be collision of ship with the rock, fire, ship attacked by the enemies, etc. These perils cause damage, destruction or disappearance of the ship and cargo and non-payment of freight. That is why marine insurance policy is taken covering all these facts. Now let us understand what are the essential elements of marine insurance or marine insurance policy. Number one is Principle of Indemnity. What is this? Under Principle of Indemnity, the insured can recover the actual amount of loss from the insurer in case of loss, subject to the limit of amount covered by the policy. Under no circumstances, profit can be made out of the contract of marine insurance policy. So another element is utmost good faith. The insured must be honest and truthful and should disclose all material facts as in case of other insurances. Another is insurable interest. Same insurable interest as in case of fire, here also it applies. It must exist at the time of loss, but not necessary at the time when the policy was taken. Another essential element is Principle of Causa Proxima. What is this? The insurer will be liable for the loss only when such loss is proximately caused by the sea perils which are stated in the policy. For example, if a loss is caused by several reasons, the nearest cause of loss will be considered only. Now students, there is a term of reinsurance and double insurance under insurances. What is that? You must understand what is reinsurance and what is double insurance. Reinsurance is a contract of insurance in which an insurer enters into a contract with another insurer to insure the whole or part of the risk covered by the first insurer. That is why it is called reinsurance. One insurance company insures the whole lot or whole business with the other insurers. It happens when an insurance company feels that it cannot bear the entire risk alone by itself. Normally, reinsurance is covered under big sectors or big private sectors where the whole assets are to be insured. So that's why one company cannot compensate the full amount, so it gets from the another insurance. So that's why it is called reinsurance. In such cases, it transfers a part of the risk to the other insurance companies. Let us take an example. Suppose a person insures his house for rupees 50 lakh with insurance X at a premium of rupees 10,000. X feels that the risk of 50 lakh is beyond its capacity. As a result, he gets the same house insured from Y. Such a contract between X and Y is known as reinsurance. It means it is between the two insurers the contract is there, as the insured is not involved in that. Reinsurance contracts are also covered by the same principle which applies to the original contract of insurance. Since contracts of reinsurance are based on principle of indemnity, they deal with the reinsurance on fire, marine, general insurance cases. What is double insurance? When more than one insurance policy is taken to cover the same risk, that it is known as double insurance. What is the impact of double insurance? The impact of double insurance is under life insurance is that double insurances may be profitable in case of life insurances, as insured can claim policy money under all the policies. A person can take up any number of life policies for any amount, and at the time of maturity he shall be entitled to claim money under all the policies. This is what the double insurance is. Now students, after covering reinsurance and double insurance, let's see what are the other types of insurances. Like you can see in the slide, motor vehicle, burglary, cattle, crop, sports. Let me brief you one by one. What is motor vehicle insurance? This policy is taken to cover the risk of theft or damage of car, injuries to or death of any passenger, or injuries to or death of third parties. The owner of a motor car may take a comprehensive policy which will cover all these risks. That is why it is a comprehensive policy under motor vehicle insurance. Another is burglary. This type of policy protects the insured from loss caused to him on account of burglary, housebreaking or theft. The insurable interest must exist at the time of loss, but not necessarily at the time when the policy was taken. Another insurance type of insurance is cattle insurance. In this contract, a sum of money is secured to the assured in the event of death of animals like bulls, buffaloes, cows, etc. Normally, this type of policy is taken by the villagers. Another is crop insurance. This contract is taken to provide financial support to farmers in the event of crop failure due to drought or flood. Another insurance is sports insurance. This policy assures a comprehensive cover available to sportsmen covering their sporting equipment, personal effects, legal liability, and personal accidental risk. This cover is not available to professional sportsmen. So these are the other type of insurances. So students, let's wind up. We have covered fire insurance, marine insurance, reinsurance, double insurance, and other insurances, and marine insurance. So let's wind up for the today. That's all. Thank you. Bye bye.